Hey guys, welcome back to my little YouTube channel, long time no here. Today's topic is investing in tech stocks still viable. The reason I decided to make this video and to have this as today's topic is because recently we've had a small sell-off in tech sector, especially in stocks that were among best performing stocks in last several months and actually a year or two. So a lot of people are starting to ask what is happening with their stock positions, why are stock falling so hard, and I will of course give you some examples. And this is actually coming from a person that has most of its investment in tech sector. My top 3 positions are actually tech companies, and my 4th position is gold mining stock. And if you have perhaps been watching my videos, you know what company I'm talking about. And we will discuss everything and what is actually my personal opinion and what am I going to do in this time of a big volatility. But before we move on, as always, just a quick overview of my portfolio. Actually in March and April I had 10% return in both March and April, and I was hovering around 20% return year to date, which is basically 10 percentage points above S&P 500, which is extremely good. But in the last several days, as you can see here, my portfolio has been declining quite significantly. And this little gap between S&P 500 and my performance has been closing actually, which is not good, but let's keep watching how is this going to end. I'm quite confident I will outperform S&P 500. I think my companies are great and they are not expensive. But again, we are in volatile times and we will see what's going to happen in the second half of this year. My cash position isn't that big, but I will be funding this account more in next few days and few weeks. So yeah, my cash position is actually approximately 20% right now compared to my overall portfolio. So let's start with today's topic. As you can see here, Nasdaq has had a little sell-off. It really isn't that significant if you are watching it from a perspective of Nasdaq. But if you dig a little bit deeper into it, you can see big differences between two groups of stocks. Group number 1, high-flying stocks with huge growth rates, and most of those stocks are actually not profitable, or if they are profitable, their PE ratios is triple digit. So they are extremely expensive, there is a lot of hype around them, and price is quite inflated, let's put it that way. For example, you can see Tesla. You can see it went from $900 to $630. Actually, in pre-market, it's hovering around $600. So it declined by more than 30%. PE ratio is what? 630. Next stock is, for example, Zoom. It used to trade at almost $600. Now it is below $300. Drop of 50%. Although Zoom is a great company, its PE ratio is still above 100, even though stock price has fallen by more than 50%. So that just shows you how expensive actually this stock is. And then, for example, we can see Peloton. It went from above $170 to $85, also approximately 50% drop. And then we have one company which I was already speaking about on my channel. As you can see year to date, it traded at almost $1,000 and now it's below $500. Also one example where stock actually has fallen by approximately 50%. Again, these are actually great companies. I like their products, I like what they are doing and where they are going. But one thing is that a lot of people actually isn't thinking about risks and they are not thinking about price that they are paying for the company. As you can see, a lot of these companies actually 5x or 7x or 10x in 1 year. And for example, if you've been watching Tesla when it was $100 and you've seen it going to 150, 200, 250, 300, perhaps you jumped into that wagon because you wanted to be part of a fast growing stock. And it kept going up, 300, 400, 5, 6, 7, up to $900, and it felt good, of course. But you have to think about risks that you are actually getting by being invested in a company that is so expensive. Because what is actually price of a company? The price of a company is actually all profits that company is going to generate in the future, discounted by some rate, which investors needs in order to his investment to be viable. So if Tesla was perhaps, let's say Tesla will generate in its lifetime $200 billion. When it was $100, perhaps it was good investment. At $150, let's say it was good investment and at that price too. But was it good investment on $300? I know it's hard to not invest in a company that's growing so fast in terms of stock price, But if you perhaps missed it, you missed it. You don't have to chase something just because it keeps going up. There will be a lot of interesting opportunities in your lifetime, and you don't need a lot of those in order to be a very, very successful investor. So my point is, in this part, you have to be very careful, and that you have to do your due diligence when you are investing in stocks, and you have to bear in mind how pricey are some companies, and you shouldn't only be watching how good are they performing. All of these companies have high growth rates, and all of them have great businesses. I'm not questioning that. But you have to bear in mind that all businesses have their price. And if you pay too much, this is what can happen. Even though we didn't have sell-off in S&P 500, we didn't have sell-off in Nasdaq, we didn't have sell-off basically in anything. Commodities are near all-time high, gold is doing okay, bonds are doing okay, tech stocks are doing generally okay, S&P 500, everything. But your stocks went down 50% without any reason. And that can happen if you overpay, and that can happen to companies that are trading at sky-high valuations. So be careful and be picky and do your homework when you are investing. Another thing that's common to tech stocks is that they don't have a lot of capex. For example, if you have a railroad company, they have to invest billions and billions of dollars in building new railroads, repairing existing one, investing a lot in equipment, in materials, etc., etc. If you have tech companies, and that is why I am invested most of my portfolio in tech companies, you don't have a lot of capex. Tech companies need what? A little bit of cloud storage or servers. They need perhaps a little bit of equipment for their employees, and that's it. Perhaps a little bit of commercial real estate to be able to have a working place for their employees, but as we've seen in last year, that's also optional. That's why I actually like tech companies, and I think they will outperform other sectors, but you have to be smart about the price. For example, look at Dropbox. They don't have any debt. They are a free cash flow machine. EPS here is actually wrong. They are on a path to generate approximately $1 of EPS, which means that their forward PE around 20, and they didn't sell off at all. You can see they are actually trading at near all-time highs. So nothing happened at these stocks, even though it's a tech company. You can check, for example, also Facebook. Yes, Facebook did trade at approximately $320, $330. It sold off by what, 6, 7, 8, 9%, but that's not even closely comparable with some other stocks that I have actually just showed you. Their PE ratio is 26, their forward PE is probably below 20. So they are cash printing machine, they are profitable, they are growing, and they are extremely, extremely cheaply valued right now. So you don't have to worry about this company selling off by 50%. Of course, it won't double or triple very fast as some of those speculative high-flying stocks could, but if you are averse to risk, if you don't want to question yourself, hey, why did my stock fall by, I don't know, 30 or 40 or 50%, like the trade desk did yesterday, this is perhaps a good stock to own. You will have more steady returns and you will be able to sleep better. For example, we can be even more extreme and show you, for example, Oracle company. They are trading at all-time high at a period when we actually have sell-off in Nasdaq. But did you ever hear from anybody that they invested in Oracle stocks? I haven't. It's not popular stock. But look at it, its PE ratio is 19, they have a lot of recurring revenue, a lot of subscription revenue, they're a really great business. Do you want to be even more extreme? Look at this company, IBM. Who would think of IBM in a period when we have Peloton, Netflix, Trade Desk, Tesla, etc., right? What would be your reaction if you would come to some meeting with the friends that are investing in stocks and you would tell them, hey, I just bought 100 stocks of IBM? They would laugh at you. But look at IBM, they are also near all-time high, and they are outperforming those shiny stocks. So you have to be careful about the price you are paying. If company is performing very good in terms of business performance, it doesn't mean their stock price cannot go down by 10, 20, 30 or 50% if stock price is overvalued. Those two things are completely different. I love tech sector. I will be mostly invested in it because of their high gross margins, because they don't have to reinvest a lot of money, because they don't have some complex machines or production facilities. A lot of my companies also have a subscription model, so their revenue is coming every single month. You can predict very nice how much of profits they are going to generate cash flow, especially if their balance sheet is good and especially if they are returning cash to investors via dividends and share buybacks, you can sleep well. But if your company is trading above 100p, if it is negative P, if it is not returning cash to shareholders, they are also probably diluting your stake in the company because they are issuing additional shares. That's not a good sign to me. I'm not saying you cannot earn a lot of money in those investments, but you should be very, very careful, at least, especially in these times when stocks like those are priced extremely high.